it is my pleasure to be here today with all of you. And please do not hesitate to share questions again throughout the presentation. And at the end, I'll be happy to go through them. I'm very glad that we get to discuss ESG in hospitality, and I'm sure that all of you are a little bit tired of the ESG term, and there are so many things happening, especially in the European context, in terms of sustainability and environmental, social, and good governance. So the presentation today is mainly to have kind of an outline and an overview of what we will be discussing and seeing, as Sonia mentioned, in the course. But I wanted to zoom out and start by thinking what's happening and why we are discussing ESG now, even though ESG has been a main area of focus and topic since 2006. It's been lately and after the COVID-19 pandemic that we have seen accelerated investment and funds pushing ESG, the ESG agenda in many different industries, but especially in real estate and commercial real estate and hotels, that we have a huge impact. And we are the first, one of the first sectors and industries that are affected by most of these ESG critical issues or factors, not only in the investment, but also in operations. And there are huge risks and potential opportunities. And I think that it's worth to kind of discuss and see what are those of these areas. So as you can see here in this image is from Triodos Bank, and Triodos Bank has been leading the responsible investment for years, and this is presenting the sort of the situation we have now, which is the poly crisis. We are facing a poly crisis that it is affecting directly and indirectly businesses, and especially hotels and hospitality industry, as we rely on destinations, geographic issues. We rely on the weather, especially for seasonality, that affects ADR and revenues for the different assets. Also, biodiversity conservation, biodiversity loss affects how we can develop the activity in the different destinations, especially when we have we have operations worldwide and different destinations. The pandemic showed us how what are the risks also in the supply chain and the supply chain shocks that we can get, the vulnerability we have in our business model if we rely on external supply chains or long distance supply chains, the emissions related issues that we have if we don't understand and we don't assess and measure and track our own performance in assets and buildings. Also the use of land. The use of land, especially in commercial real estate or in hotels, is huge, because we have a great impact in local communities, indigenous communities, and that also affects return and long-term viability of projects and feasibility of projects. So we have to assess those ESG factors when we are discussing the projects. Not only at the investment time, but also in the retrofitting process with investment teams, in the operations teams, in strategy, because it does affect returns. And also resources scarcity. We're having such a heavy, intense F&B or food and beverage operations. We also depend on resources such as ingredients. We depend as well on local availability of natural resources, such as, we will see some examples now, but there is so many risks that could affect that we have to have this 360 view and zoom out and say, okay, this is not just ESG factors, but also from the different risks in terms of what's happening in the different sites where we have operations. So why we are discussing ESG? So ESG is increasingly being recognized in our industry as a value creation. So it's not just the perception of the risk assessment as we have seen over the past years, but also how we can use ESG as a value creation method for our new projects, how we can use ESG as a driver of value for the different stakeholders in our industry. And I think that's key, because even though ESG is complex, we have to see it as an opportunity to create beneficial or benefits or positive impacts for the different business stakeholders. And why is now ESG relevant? Why now? So we have 4 main factors that we will see in depth, but here we have like an overview of what are the 4 main areas that we are seeing as driving ESG momentum over the years, especially from the regulation perspective and international trade and European countries. What's happening, for instance, with the EU CSRD that today actually is being discussed and voting, because the Corporate Sustainability Reporting Directive, of some of you, I'm sure you've heard of, is pushing boundaries in terms of materiality assessment, is pushing boundaries in terms of disclosure requirements, and is putting a lot of pressure, not just in the financial sector, but also in the non-financial reporting. And that is pushing the agenda of actually taking action and now being regulated is a huge step for sustainability and ESG. And also standards. Many standards are being, well, some of the standards that are currently being developed are also supporting this transition, but are complex, such as TCFD and others that we will see. From the consumer perspective, or the guest, in our case, where we discuss about hotels and hospitality, the guest also perceives as a need. And not just, it used to be just the educated consumer or the educated guest that was requesting information about sustainability performance, but now is more in the different products that exist within the commercial real estate. We have different guests that are actually requesting it, and also from the corporate side. So in the RFPs before, from the corporate clients, we used to have the requests from data, from accommodations, for instance, but now big accounts, such as could be BMW or any big corporate accounts, are requesting data from environmental, social, and good governance performance. And that is important and is key here, because it's also driving business. So the revenue depends on the performance in those key metrics and indicators. And also from the investor side, we've seen a huge push from the responsible investment, impact investing. There are countless initiatives starting from principles for responsible investment to human rights for investors, and so many pledges that are supporting this momentum of responsible investment and impact investing. And then from the operational side that I was mentioning before, we can have shocks in our supply chain if we don't manage ESG risk correctly. Also from climate mitigation and climate change, as we will see, if we don't have contingency plans, if we don't have a scenario planning, all those actions, if we don't take those actions, it will affect to valuation and returns. So we will see in depth what really means all of this. But just some figures here. The latest research from Workviva in 2023 from practitioners show that 74% of respondents expect to comply with 2 or more regulations. So at least CSRD, if you are operating in Europe, CSRD is a big one. CSDD, which is the one for the human rights due diligence as well. 2 main regulations pushing for disclosure, pushing for indicators. And then the technology side. So technology will play a key role here in terms of disclosure, in terms of ESG reporting, in terms of data assessment, benchmarkings, and also to create strategies and have a smart and informed decision making, especially for investors. So even though sustainability and responsible investment is maturing, we still have a long way to go in terms of understanding what ESG means and what are the complexities, going beyond just carbon emissions, decarbonization, net zero pledges, and understanding that ESG is a way to create long-term value for the brand, regardless of the company, regardless of the investment. ESG is how do I create long-term value for the different stakeholders, but also understanding the huge risks that we are facing in this transition. So we will see, and I'm sure in the course as well, we will see transitional risk that are and will affect properties and assets, and also climate-related risks. We will see all of that, and how technologies can help us sort of to monitor and improve that. Some of the rationale or the motivation that the sustainable investment has been implemented, and is because some products is because just the client demanded the information, so disclosure requirements are being asked from the different business stakeholders, also to mitigate long-term investment risks. Especially in real estate, we've seen that to avoid reputational risks. So if we don't have certifications, fiduciary duty and due diligence processes, but also voluntary, like how we can have a greater impact without expecting regulation requirements. So how we can, by doing this project, this investment, or this specific activity, how we can create proactively positive societal good or societal good impact in society from the different activities that we are doing, all the investment. From the CapEx and OpEx perspective, we will see some examples as well. And also from the regulation perspective, we've seen that as a two, the regulation is tricky, because as we will see from the regulation requirements, we have two main areas. One is voluntary reporting, and the other voluntary disclosures, and the other one are mandatory disclosures. And it can, there is any sector agnostic at the moment. So what happens is that, especially from real estate and especially from hotels, we don't have a specific guidance of what are our material impacts. So it can have like that gray area that can be challenging, and also because it's just for mainly trading companies and not just SMEs. And the structure of hospitality companies is relying on data from SMEs. And it's hard to get that data from SMEs when those are not well-structured internal governance, when those don't have technology that allows us to get that data for investors. And so it's quite tricky, but I'm sure it's going to be, or at least is being perceived as a way to have a standardization in terms of what we need of information from the different stakeholders. So we will go and I will share with more information about it in a second, but I just wanted to show you here some of the main entities driving change, and I'm sure you've heard of at least one or two of them from the image. So whether it's the PRI, as I was mentioning before, since 2006, Principles for Responsible Investment has trillions of assets under management that are driving capital toward impact investing, or at least supporting the community sort of to feed each other from information and best practices. The Natural Conservancy or the World Benchmarking Alliance, which are supporting from environmental or social and human rights perspective, are giving assessments and benchmarking in terms of what are the best practices and how where we're lacking action, and what are the main challenges globally, especially in human capital management. World Resources Institute, or the CRREM, which is more about the risk assessment, whether it's from the resources perspective or from the building. Now that
sorry, Maribel. Yeah, yes. There was a problem with the recording. It's okay now.
Okay. So as I was mentioning, the PRI, so they have more than 60 trillion in assets worth the signatories being committed to their principles. So that is a huge shift in terms of capital allocation and impact investing, and trying to do good from the core of any strategy. So in ways that the investment regulation, as we were mentioning, is being helpful or is supporting sort of the industry is because it helps investors to understand the disclosures and how they can implement that into the investment outcomes, and also improve the quality of consistency. The standardization, as I was mentioning, is very important, and remove barriers that we've seen in the investment adoptions, and sort of support that due diligence. It's also been supporting that due diligence process. So in terms of the European landscape, which is the main or the leading, I would say, like the leading continent that is actually taking action, or it's been at the forefront of this movement of responsible investment for years, now being consolidated with the taxonomy since 2020, taxonomy, and now the Corporate Sustainability Reporting Directive, that is an evolution from the non-financial disclosure reporting directive. So those different regulations are supporting this transition, and again, not from the investor perspective, but also from the strategy and the operations, because it's giving us details in terms of what are the KPIs, what are the areas, what are the materiality areas, how do we, what's the best way to do the materiality assessments, and what are the different disclosures from the environmental, the social, and the good governance perspective that we are expected to have or to inform or to disclose every financial year. As we've seen with other standards, the regulation is more focused on the double materiality, which means, and we will see that also in the course, double materiality is when we not just only assess the impact on our financial performance of those risks, but also the impact that the company has on the art intake it has into the different environments or the different destinations where we operate, on the human capital, on the supply chain human capital, and many other areas. So like I would say that from the taxonomy perspective, and the Article 9 and the 6 environmental objectives that are like the main objectives from this transition that we are seeing, not just in the real estate sector, but in many others, is the climate change mitigation, the adaptation that we have to have, the plans, the sustainability, use, and protection of water and marine resources. That is also part of the disclosure requirements in the CSRD regulation. The pollution prevention and control, and restoration of biodiversity and ecosystems. So if we think about developing any kind of new real estate, we will, or the activity will be into any of those 6 categories that we have to take action. So all are material for the real estate sector. And as I was mentioning, double materiality would see the combination. So financial materiality is what we have seen and what we did for a while, where we just have information about the financial performance and it's an outside-in approach. And now with the CSRD regulation being developed by EFRAG in the European Union, now we have like impact materiality, which is aligned with the GRI, or the Global Reporting Initiative, that I'm sure that you are familiar with. And that reporting, so the GRI and the CSRD are together working to have interoperability and have a better understanding of how the non-financial disclosures align to the regulation requirements, and how is the best way to have that materiality assessed. And I believe that's a critical point, because the disclosure requirements go from what's happening in operations to education to how the employees are being, what are the conditions, the human capital conditions, biodiversity conservation plans, and risks that will affect potentially to the company if we don't take action, remuneration, R&D, which is critical, especially when we talk about water resources, water and marine resources, and some other environmental areas. If we don't have R&D from local operations, is a critical information that we need. So as you will see, there is a recent report that I wanted to add today from Ernst & Young from the EU Taxonomy Barometer that I think is worthwhile having a look at. It was disclosed, it was shared this month, and I believe is great to have a look into it because it's sharing the barometer from the EU taxonomy perspective and also showing, or in a way, seeing the misalignment between what is eligible in terms of the turnover from the real estate companies and what is actually aligned in terms of the EU taxonomy and the action that has to be taken to close the gap. So I think is a worth if you have the moment, and I'm sure Sonia can share the link and we will share it with you to see the performance and what's going to happen in the coming years. And some of examples of how we can use actually technology and how ESG data can be implemented into investment decisions and some actions we've seen recently is the use of geospatial intelligence or technology to mitigate risks and actually tell us the risk in terms of valuation from assets in the different portfolios and tell us from the climate related risks, how is the likelihood, what's the percentage, what's the millions in risks. And I believe is a great way to internalize or start adding technology in the sector. Reporting, we've seen ESG reporting for a while and technology applied to reporting, but using this type of technologies to assess and predict the impact of climate-related impacts to such as extreme weather events in a property is a great case scenario to use technology. And I added here just an example with Source Global. There is a technology that uses, again, this kind of intelligent technology to give data. There are others such as Clarity AI at the portfolio level. If we have different sectors, real estate and others, and we want to see how is the performance and what are the alignment with the taxonomy, or we want to see a specific ESG indicators and how we are, or the benchmarking and how we are performing against peers. Clarity AI is another great technology that can be used sort of to analyze it. I don't know if there's any questions, but maybe I'll just wait when I finalize, right? Sonia, you tell me if there's something that I need to stop or reply to.
Everything is fine. We will address them at the end, Maribel.
Okay, that's great. So just very quickly and as an overview, how we can create those positive impacts from the real estate perspective and not just mitigate negative impacts, because when we discuss about net zero pledges, decarbonization of assets, we are very narrow. So the view is very narrow. So we have to have a more 360 view and see how we can create positive impacts by having a real estate activity, and especially with hotels, how by creating retrofitting or creating these new brands, how we can create positive impacts at the core, and that's great. And this is a very good example from the Living Building Challenge that I do also recommend you to have a look to this initiative. The Living Building Challenge, it supports sort of with a framework how you can go beyond just the carbonization of assets, how you can go beyond the net zero and actually being net positive. And net positive means creating positive outcomes for the different stakeholders and not just cutting emissions or compensating emissions, CO2 emissions, but also going way beyond. And especially in assets, in commercial assets like hotels, we have a huge impact with other emissions, not CO2 related, such as methane from food waste, that has to be integrated into the building performance indicators, and it has to be part of this assessment. So this is a great example in how to create, and also gives you a competitive advantage. But what happens, and the main challenge we have in our industry is like the stakeholders, because it's such a fragmented industry. And I wanted to add just an example, for instance, Wyndham, that Wyndham has an asset-light business sort of approach because it's focused on franchising, but it depends on the owners of the real estate to actually take action. So from the ownership perspective, from the franchise perspective, from the operator, is we have to understand who is responsible for what in terms of the ESG performance, in terms of the data collection, in terms of the technology integration, in terms of the education. So I think here is where we find the most of the challenges in a daily basis, is who is responsible for what and what data do we need to collect at every point. And as we were just discussing before, some of the main challenges we've seen as market example in the transitional risks are affecting actually deals nowadays. And some investors are abandoning the deals. And one recent example from the ULI survey is that risk involved in decarbonization of assets have led to those acquisitions not going ahead, because it's just an example of what more examples to see of more case scenarios we will see in the coming years, because we will have climatic and non-climatic risk interact. So the way we have to protect ourselves is creating those case scenarios, creating contingency plans and taking action, decarbonization assets, reducing impacts, and if it's a new retrofit, if it's a retrofit, from the material perspective to the circularity analysis, to the biodiversity conservation analysis. So there are so many pieces that we have to put together in order to reduce risk and tackle opportunities. But one of the main risks is having a stranded assets in commercial real estate and losing the license to operate, because this asset inability to perform and comply with the law. So we will see more cases, and it's great that we tackle those ESG and social sustainability issues proactively without expecting regulations to actually ask us to further disclose, to be aligned with taxonomy or to any other upcoming regulation. But the environmental side is not it. We also have the social side and a strong governance, which is key and crucial and hasn't been in the main stage for a while. We have to sort of have this focus on emissions and net zero transitions and net positive, but now we have to understand what is the social issues and how do we create the governance structures we need to drive change, and is part of the ESG, and has been ignored and not I would say not as a focus, but is being secondary and is critical, as we see here, because of this is the donut economic model by Kate Radworth, an economist, that she created this in 2017, sort of to have an image and a visual image of what really means not taking action from the social perspective and without the social foundation, regardless of the environmental impacts. We need the education, we need the justice, the peace, the social equity, gender equality. D&I has been I would say tick box exercise for the past years. So how we actually take action on gender equality from the real estate and sector. This is critical when we are talking about land rights and indigenous people, and especially in developing countries where some of the biggest brands in commercial real estate operate. So our big conversation still to have, and setting indicators for all of these social foundation areas is critical, so we can be within the ecological ceiling. And also I added here the SDGs, because the SDGs are known, or the Sustainable Development Goals are known and shown since they were adopted back in 2015. However, we need more proactive approach than the SDGs, because the SDGs were set up for countries, but we need more like a company level understanding of the impacts. And with the SDGs, the indicators, if you read them, I'm sure you did, the 169 metrics are for countries to develop the Sustainable Development Agenda. But if we want to develop this from the ESG perspective, from the creating value for the different stakeholders in a proactive way, we have to focus on a bigger picture, and the SDGs are not the right framework. We have to zoom out and understand that all the social foundation areas that we have to create, such as education, income and work, like labor relations, the food processes, health, energy transition, all that goes way beyond the SDGs. And then understand what is our activity. So as we were having a chat before, and we were saying, if we want to actually be sustainability and ESG value-driven company, we cannot just continue to have new buildings in developing countries where regulations are less strict than in European Union, and not have or apply those regulations and sort of have lower brand standards or more less strict brand standards, and just create a new property there, a branded residence, whatever it is, that actually is crossing the ecological ceiling and doesn't have a climate change adaptation plan, or it doesn't even count for the chemical pollution of that will create in the destination, the land conversion or land rights, where we have this new development. So I think that's the question. So sort of, are we doing things right or not, and what is the intention to by having this new development or retrofit? And another example of social can be the D&I. So this is the Women Empowerment Principles from the United Nations as well. I do recommend you to go. You can join the pledge and support, and sort of having more women at the board level. And it's also a big challenge in our industry. So just another example of initiatives that are supporting. And as a certifications as well, because as more acquisitions happen, I believe that what's being requested most at the moment and at this point is the certifications, whether it's LEED, BREEAM in the UK, or some others that are the leading certifications. Is like the first thing to ask. Oh, well, that building is being certified, and is it gold? Is it what's the performance, right? But it's great that at the end of this talk you have like this 360 view that environmental issues are critical, but everything is connected, and social issues and human rights is a huge part of the ESG that we still have to tackle when we're having a strong sort of governance internally. And yes, as a big opportunities are biodiversity net gain. So how, by creating this new development, for instance, we can create positive impacts locally that can be measured, that can be tracked, from the materials used to the life cycle assessment, to the local engagement, I think that as a real estate industry, we have so many great opportunities. But one thing for sure, we cannot continue with business as usual, as it is a threat to Earth systems, and it can actually be a huge operational risks for any given asset if we don't have protocols, if we don't have internal education, contingency plans, scenario planning, adaptation plans is critical for the years to come. So as we will see in more regulations and different standards and moving forward, I think that impact management is going to be the way forward. So it's a value to impact, right? So how we can create impact from the different areas, and understand the financial aspects and how those financial risks relate to environmental and social impacts with a double materiality perspective from the investors, operators, franchisors, and everyone that is contractors and design and architecture firms. Everyone has a role to play, and I believe that the critical or the challenge we have here is the communication. So the communication between the stakeholders, so we have the right data, we understand what's the best certification, we choose the right technology to measure the impacts. I think that's going to be the main challenge moving forward. But definitely having a strong governance is needed, because ESG affects yields, it affects returns, valuation, and we cannot afford not to take action. And if we want to create long-term value in any kind of a sort of a strategy, regardless of the company, we must have a strong ESG internal governance and structure.